Let's talk briefly about a fundamental truth that you must understand if you're to be effective in the infinite banking system and privatized banking. It's called the finance trap. The premise of the finance trap, and y'all, this is immutable law, okay? This is just the truth. The finance law stipulates or says or reveals, uncovers, highlights for us that everything you ever buy is financed. Everything. How much of it, Scott? Everything. Everything we ever buy is financed. And you're saying, well, Scott, how can that be true? I mean, sometimes I pay cash, you know, I don't finance everything I ever get. Well, stay with me for a second. Let's go through this, okay? Let's buy a $30,000 used car. I know, depending upon when you're watching this, that may not buy much of a used car, but let's say that we're doing this, a $30,000 used car. So you've got two options. About what 94% of America does is they do this option. They borrow the money. Well, what's that mean? That means they pay interest, right? They're paying interest to the bank, to the finance company, the car company, whomever. They're paying interest to someone else who's already accumulated the capital because they haven't, right? So they're paying interest. Now, how serious is that? Well, it's not the interest rate that matters. So here's what I want you to do. Somewhere in your notes, write the word rate, R-I-T-E, and draw a line through it. It's not the interest rate that matters, it's the interest volume. You see, your bank account doesn't recognize an interest rate. You know, if you say, well, I've got a 3% 30-year fixed on my mortgage, your bank account doesn't recognize that. Your bank knows what it translates into, right? That you've got a $3,112 principal and interest payment, you know, that's drafted from your account. That's interest volume, okay? The volume of interest, that's what's important. I want you to know the volume of interest that you have to pay. If you don't hear anything else I say in this video series, you need to know what is the interest volume I'm paying on a monthly basis. On average in the United States, it's 34.5%. That is a massive number. That means if your take-home pay is $100,000, that $34,500 is going to pay other people for the benefit of using their capital in the form of interest rates and charges and fees, okay, 34.5%. You say, well, Scott, I listen to Dave Ramsey or I listen to other financial, you know, experts, quote unquote, and so I don't finance things. I pay cash. You know, I'm sophisticated. You know, I've elevated myself. Okay, well, fine. So if you pay cash, then you're actually losing interest. You say, Scott, what do you mean I'm losing interest? I mean, because what you could have done is you could have put that cash inside of an interest-bearing vehicle, like one of our IBC policies, for instance, and it could have been earning 6% or even higher if you use some of our loan leverage, 6% or higher rates of return, right? Interest rates, but by volume, we don't focus on interest rates, we focus on banking, but I'm saying that money could have been growing, right? It could have been an account that was growing. Well, how much would it have grown by? A lot. Over a factor of 20 years, it's a factor of 2.2. Okay, so in 20 years, you paying cash for that car, if I pay cash for it today, then I fast forward 20 years out into the future, that car actually cost me $66,000. The price of it was $30,000, the cost was $66,000, significantly more. Why? Because my cash has a cost associated with it. Capital has a cost, right? So if I'm paying cash for everything, I'm losing the interest that could have gained. Why? Because I chose to use my own cash to go deploy it and to buy a vehicle. So neither one of these are very good methods. You're caught. You can either do this or you can do this. You have no other options if you're not privatizing money because you don't have access to a consistent, systematic, collateralized account. If you don't have access to that, then you're stuck in one of those two options. Okay? We give you a third option, and the third option is becoming your own banker. And with us, we have you use the insurance carrier's money, not your own. And most of the time, you can do that at zero cost. Sometimes you even make a profit from using the insurance company's money. So we give you a third option, so you don't lose 34.5% of your take-home pay. You don't lose or pay double for all your significant purchase items. You don't have to lose all this money. We give you a way where you can protect that, keep all that money back in-house, and make things more efficient in your personal economy by becoming your own banker.